All right, it's party time. Hi, folks. So the big questions for this month are, what is tactical investing and how does it work? Last month, we discussed protected investing. This month, it's tactical investing. And just like last month, these are exactly the questions that we intend to answer today on this webinar. And again, we're so extremely excited to be discussing this topic today as well. And again, just like last month, because we believe in it so much, but also because it's great timing to do so due to the stock and bond markets experiencing so much volatility over the last couple of years, but especially this year. Also, because so many people these days have been wondering if their portfolios are really invested in the best way that they could be, especially when it comes to protecting from major losses related to major market downturns. Well, again, just like last month, I have to tell you, if that's you, then you're really going to enjoy this webinar today. Not only are we going to unfold the concept of tactical investing, but we're also using this opportunity to introduce another third-party money manager named Redwood Investment Management, who we feel are the tops in the field among investment managers when it comes to tactical investing today, and with whom we have been working with for the last couple of years when it comes to roughly about 95% of our clients' portfolios allocation portions in order to minimize their volatility and maximize their returns. On top of that, we are super duper excited to be co-hosting this webinar with our firm's designated advisor analyst from Redwood, Zach Willms. Zach is a certified investment management analyst at Redwood, a University of Penn Wharton School graduate, and an expert in tactical investing. Thanks for being with us here today. Zach, how's it going?
It's going well. Thanks for having me. It's a pleasure.
I'll tell you, man, we really had to go through a lot of red tape to get this going, didn't we?
We did, but we got it done.
Yeah, no, I'm super excited. I'm as scared as I was. I'm that much more excited that we pulled it off and we're doing this today. Okay, folks, I hope you can tell that we have a really special workshop planned for you this month too, one that we think will be both educational and enlightening. With that said, I want to thank each of you for attending today. Our topic, as you know, is what is tactical investing. My name is Brian Dougherty of PLC Financial Solutions. I'm your regular host for it tonight, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hey, everybody.
And she will be our moderator for it, as always. She's back. Rachel was off last month for the first time in a year and a half. Not doing that again, Rachel. Hopefully, we can avoid it. She'll be handling all the comments and questions in our comment and Q&A boxes as we go along. Also, before we get started, let's take care of some general housekeeping first. First, if this screen is not big enough for you to read or see the images good enough, you can click on the View Options drop-down at the top right of the screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One called Chat, it's for your comments, and another called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Now, another thing, you can also email your questions into us at info@plcfs.com if you find that easy to do while watching the presentation instead of navigating between these boxes and typing in there. Might be able to get your phone out and be watching and send an email. Just a suggestion. Next, I'm sure that many of you are going to have some questions about the material we'll be covering today. But since we have a good bit of material to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in those boxes below or an email to us and at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will actually be posting a link at the end of this for you to be able to do that. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it out again at your convenience. Also, because we want to make sure that you're all paying attention, and because we'd like you to have some fun as well, before we answer any questions, we have a 6-question quiz. As always, some of our regulars, they always get on it, Zach, for you to do at the end. And the first person that answers each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure you have a notebook handy to jot down some of the brief notes related to some of the special bullet points. When I do a bullet point, get that notebook out. And then I'm going to point them out as we go. So finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. Okay, so now that we got that out of the way, I have one for you. As usual, this is an oldie but a goodie too. Rachel's going to recognize it. Why did the turkey cross the road? Rachel knows the answer. To prove he wasn't a chicken. Okay. So I did get that one from my older son, Case, when he was in Cub Scouts a few years back. It was one of my original jokes that I used to use at my very first Social Security seminars that I did. So, okay, I'm going to keep a day job like they always say, right? I will do that. But it wasn't a bad one. It's kind of cute, right, Zach? Good for a chuckle, right?
I liked it.
Nice. Okay, let's get started here. So a little background on Redwood. They are a client-centric money manager that was founded in 2010 on the principle that investment success requires a focus on drawdown risk in order to minimize portfolio volatility. Now, they manage over $2.5 billion in assets using quantitative strategies through what they call engineered risk budgeted portfolios, or ERB portfolios for short. You're going to hear that more. Now, next, bullet point. Get those notebooks out. Bullet point. They're non-binary research-based risk-first approach. I'm going to say that again. Risk-first approach. Write that down. Is built to position individuals, investors, for sustainable success through advisor-client alignment and clear and achievable investment expectations. And we're going to go through that. So basically, folks, Redwood believes that the risk in a portfolio can be controlled more than the returns can. But as it turns out, when risk is mitigated through the use of a tactical investment approach, which employs the use of algorithms that are fed market and economic data to trigger trades versus pure human judgment or instinct, usually the returns end up being better than average as well. And you'll see that later in the workshop. Okay, Zach, is there anything you'd like to add here? Got your company?
I think you nailed it.
All right, got it all. I do a pretty good job, researching. I'm not going to pat myself too hard on the back. All right. Now, Zach, you stumped me on this, okay? And I'm sure you're going to stump a lot of other people. Where do ideas come from? Where do the ideas come from? Can you enlighten us on this? What's it all about?
Yeah, well, like you, I also like to laugh. And this is one of my favorites, but it's also a little sad too, because it's pretty relevant to today's financial market. So starting at the top left, this is a diagram moving from left to right and then down from the bottom, left to right again. And it's a good representation of how ideas nowadays are transitioned from one individual to the next. So the very beginning, the guy says, I've got a stock here that could really excel. The next person says, really excel? Excel? Sell. This is madness. I can't take anymore. Goodbye. Goodbye. Bye. So you can see how one idea get changed into something else, and then
that's how it all happens. That's how it happens, right?
Exactly.
Okay, so folks, you heard it from Zach, not me. That's how it happens. Okay. All right, so let's my little thing's not working. Okay, so why does Redwood find that this approach to investing is more reliable? Well, it's simply because the truth about financial markets is that they are totally unpredictable. You can see here, when it comes to the yield on 10-year Treasury notes from 2018 through 2021, as an example, you can see in this slide that it was all over the place and completely unpredictable when every single one of these lines above represents a different expert's prediction of what the 10-year Treasury notes returns would be for that given year. That's a lot of predictions, Zach. What's your take here?
Yeah, I mean, this is just a perfect representation of, these are all experts over in Wall Street, people getting paid millions of dollars. They have all the resources that they could ever want to have. And all they have to do is just predict where the 10-year yield is going to end the end of that given year. And you can see that they can't even get the direction right?
Unbelievable. Some are going down, some are flat, some are above. It's like everything across the board, right?
Exactly.
What else can't you predict?
and many people like to pontificate about what the market's going to do. And the truth is that nobody knows. And there's no point of trying to predict. So let's just focus on what we can control.
Yeah, let's just face this reality. But it makes for great theater, right?
Exactly. The talking heads.
The talking heads. Exactly. People love it. That's why we watch. Hey, listen, that's why we I tell you, I hate to say it, but that's why I read my financial news every morning. Every time it says whether the market was up or down, they know exactly why. Exactly. Mm-hmm. Well, it's commodities or whatever it was. They know. Right? Unbelievable.
Exactly.
So it's at least a good talking point. All right. So to further make the point of unpredictable markets, let's look at this, the chart of the S&P 500 from 1990 to the year 2000. The average annual return was 18.16% for that decade. So because of this, what do you think that most people would have predicted moving forward into the first decade of the millennium? If your first thought is more of these skyrocketing returns, then you're not alone, believe me. Don't you think? I mean, Zach, what do people tell? What's your take when you talk to people? When you say, even we've experienced this over the last, leading up to before 2018, right?
Oh, 100%. Yeah, and this is a crucial measure too, because 10-year lookbacks is what by far is most common in the industry to look at how an investment is going to perhaps perform over the next 10 years or the next time frame that we're looking at. And so this just shows that, I mean, we'll see on the next slide, but based on this report right now, I would think that I'd be getting somewhere around 18%.
Absolutely. So the suspense is killing me. Right? Uh-oh. What happened, Zach?
Not even positive. So about negative 1% annualized. And what that means is every single year on average, it was about negative 1%. And that is only if the client held through those 10 years, meaning they didn't sell out. And then, I mean, look at the chart here, right? You have to hold through not one, but two massive market losses of over 40%. So imagine you have $100,000. 2 times you would see that $100,000 go to $60,000.
Oh my
I
God!
don't know about
Anybody
you guys.
retiring in that decade, man? A lot of heart attacks.
That's the it's known as the lost decade right here.
Absolutely. So as you can see, folks, markets are completely unpredictable. And anyone that tells you otherwise is really just speculating, regardless of their education or credentials. Unless, of course, they have a crystal ball, then you can probably believe them, right? Right?
And call me if you find someone with one.
Yeah, I got that bridge in Brooklyn I want to sell you. You know, the whole deal, right? So yeah, I think this drives the point home. So you can see, this is why Redwood believes that predicting markets doesn't work, and why they believe that tactical investing is the way of the future. Okay, Zach, you got this one, buddy.
Yeah, so here's another, so going back to the last slide, how we were talking about only if you held through those 2 losses, would you have gotten that negative 1%? If you had sold out and bought back in at a higher percent, those numbers would have looked even worse. If you were one of those people that thought, hey, maybe I would have held through those 10 years, wouldn't have sold out. Well, let's look at some statistics on that. So this is the Dalbar study. Dalbar is just the company that conducts the study. It took a look at 2 mutual funds over the course of 20 years to see how they performed. And so one of them followed the S&P 500. You can see that in the dark blue with a 7.47% return.
Okay.
The second mutual fund was the Barclays Ag Index, which, if you're not familiar with that, it's the most commonly referred to fixed income index.
Yeah, I mean, that's what we refer to as the stock market and the bond market, pretty much. I mean,
exactly.
in the U.S.
And then the study took a look at what the average investor into those 2 mutual funds received on their investment over that same 20-year period. And you can see there's a pretty big negative delta here. So individuals are not receiving the amount of performance of the funds in which they invest. And the reason for that is because they're getting emotional. They're not buying and holding. They're selling out when the markets fall, buying back in at inopportune times, which hurts their performance.
Breaking the #1 rule, right? You know, buying high and selling low. Supposed to buy low and sell high, right?
Exactly. But I got to say, I mean, I experience it. I'm sure, other people experience it as well. It's just natural human behavior. It's pretty much just the basics of
you get scared when markets drop, and that's it.
Yeah.
That's basically it. I mean, hear it from my clients all the time. And this is why it's good to go through these things, to, just to keep them steady and educated on, what the facts are about it.
Mm-hmm.
Right. So, now this one's like, there isn't even a lot of content here. Zach's got this memorized. What is it, Zach?
Hope you like my my clip arts I put in there. But this is another reason why large losses are so detrimental for individual investors like all of you who are attending right now. So traditional asset allocation, so just long only funds, not tactical, those were built for institutions, which is what you see on the right. An endowment fund, a pension fund. Those institutions have infinite time horizons. When the market falls, not a big deal. They just add more money to the fire. And it's actually a great time to buy because it's a discount buy opportunity.
Yeah.
But if we look at the left, when we're talking about individuals, they don't have infinite time horizons. They need access to their capital, whether it be pulling out monthly withdrawals to support their lifestyle, or maybe they have a medical emergency, or kids going to college, or some other need for capital. And so anytime you pull money out of your account during a market loss, it's going to significantly impact your ability just to get back up to where you used to be, just to get back up to par.
Yeah, no, absolutely. What people, you got an institution, they're not retiring.
Exactly.
Yeah, they're not having medical issues they got to pay for. They're not having, life events. It's an institution. So they can invest in ways that people who have these things can't.
100%.
All right, so I got it now. All right, I got it. Okay, so let's talk about another reason to manage loss in your portfolio. In this slide, there are two examples of what type of rebound returns it will take if a portfolio takes a certain amount of loss at any given time. It's showing this under two circumstances. The first, in the green columns, is with a portfolio that is not being withdrawn from. And the second, in the yellow columns, is with one that is being withdrawn from at a rate of 6% annually. As you can see from the first set of columns all the way on the left, a 10% market decline will require the green column with no withdrawals to have an 11.1% increased return to get back to even. And the yellow column with 6% annual withdrawals to have a 19.1, that's 19.1% increase to get back a 10% drawdown to break even. So obviously, the greater the market decline, the greater the increased returns will have to be in order to get back to even again. This is one of the most compelling reasons that you want to do everything you can to minimize the drawdowns in your portfolio. Zach, take it away, man. Tell us about these other columns.
Yeah, I think this is a really impactful depiction just because a lot of people, when they lose 20%, let's say, it's pretty easy to think, oh, I just need 20% now to get back up to where I used to be. But it's not the case. It's called the math of loss. And so if we look at that third group of columns, if you experience a 20% loss,
which is what happened this year so far, right?
Yeah, exactly. You need a 25% gain now to break even, just to get back up to where you used to be. And on top of that, if you're taking money out of your account, you're going to need a much larger gain than that to break even. In this case, 35.1% if you're taking 6% withdrawal out of your portfolio at the end of every single year, just to support your lifestyle or whatever reason you need that money.
Yeah, absolutely. I always tell clients that depending on, if they're withdrawing, depending on how many years it takes it to come back, you take 30, you're taking 6% for 2 or 3 years. It doesn't come back for 3 years. You took 18% before it comes back. Now you got to do 18% against that number. It just gets worse and worse. So absolutely love this slide, man. People, this is the kind of education I think they really need, especially at times like this.
Yeah, and that's called, formally in finance, it's called sequence of returns risk. As you're accumulating money during the growth accumulation phase, the order of gains and losses, it doesn't matter. You're going to end up in the same spot. But when you're withdrawing money, the orders of gains and losses has a massive impact of where you end up, meaning either you run out of money or you have enough money.
Rachel knows that sequence of returns concept well, right? All those webinars or seminars we did, Rachel, and we had that big, 2 or 3 slide run that we used to do towards the finale. Has a lot of impact. Absolutely. Okay. Pay attention, folks. This is a big one here. Okay, so now let's talk about why Redwood believes that traditional asset allocation models just don't work anymore. And it's really the staple of what most people's portfolios are these days. And this is actually the evidence or the proof of why it doesn't work anymore. First, let me give you a little background on what are known as traditional, or you're going to hear us using these terms. They all mean the same thing, either traditional or static or long only asset allocation models for for portfolios. And where this came from, they stem from what's known as the efficient frontier portfolio theory that was introduced by Nobel laureate Harry Markowitz in 1952. and became the cornerstone of what is known in finance as the bullet point. Get the notebooks out. Bullet point. Modern portfolio theory. Write that down. Modern portfolio theory. I was going to throw in Harry Markowitz too, but I was like, I don't know. That might be good. Are you good? 1952 is a good one. That's how long ago this was created by Harry Markowitz. It's also called the MPT for short. MPT suggests that a conservative investor can do better by choosing a mix of low risk and riskier investments than by just choosing an entirely low risk portfolio. At its heart, modern portfolio theory makes and supports two key arguments. The first is that a portfolio's total risk and return profile is more important than the risk return profile of any individual investment. And two, that by understanding this, it is possible for an investor to build a diversified portfolio of multiple assets to optimize their risk return ratio. So when you look at this chart, it starts by plotting the 100% bond portfolio or allocation at the starting point. So you see this here, folks, it says 100% bonds. That's where it starts. At that point, it shows that if you're willing to risk roughly 9.7% of your portfolio, you could get a potential return of roughly 5.6%. Do you remember them days? Well, we're coming towards that, maybe in a few years, after all these bonds mature. Then what happens is totally surprising. As stocks are mixed into the portfolio at different percentages, the rate of risk actually begins to decrease and the potential returns start to increase when you think it'd be the opposite, right? So by adding stocks to the mix, to the risk, it actually, by adding stocks to the mix, the risk actually goes down at first, not up. That Harry Markowitz was a real genius, I'll tell you, for figuring this out, guys. When I first saw this years ago, it blew my mind, okay? And people need to know this. Then you can see that at the 25% stock, 75% bond mix, the return increases to roughly about 9.9% at the same time that the risk bottoms out at roughly 8.1%. So you can see here, can you see my cursor here? This one all the way to the left, that's the 25% stock, 75% bond mix. As it comes down here, this is the risk on the bottom. This is the return on the left side here. It actually starts to go down the risk axis until it gets to that mix. And so you bottom out. It actually is at its lowest risk right there with 25% stocks in and 75% bonds. Okay. It's all so it's at that asset allocation where the portfolio provides the most return for the least amount of risk. But then further up the line, it was discovered that at a 60% stock, 40% bond asset allocation, that the portfolio would provide the most return with no extra risk than the 100% bond portfolio originally encountered. So you can see, here's the risk of the 100% bond as it turns that corner. Kind of looks like the Nike symbol, doesn't it? A little bit like the Nike symbol. As it turns that corner going right where this blue circle is, that is the 60% stock, 40% bond asset allocation. It's jumping from about almost a 6% return at the same rate. This was in 1952, by the way, though. Remember this, okay? It's almost like a 13% return. Man, what a mind-boggling discovery that was. Okay. So it was considered at that time in 1952 to be the most efficient or optimal portfolio, the 60-40 allocation. Okay, Zach, before we show people how this all plays out today, what insight can you give them about this? How did I run that then? Was it good or?
Yeah, I think that was great description. So hopefully I don't repeat you too much, but I'll just reinforce what you just covered. I mean, Harry Markowitz, if you go into finance, he's a name you're going to hear within the first week of getting into the industry. Nobel Prize winner. His big, claim to fame was his modern portfolio theory, which you just went over. This is still how the vast majority of financial institutions are going to build their portfolios. What is the optimal portfolio, which is that blue circle? Just as you described, you want to find the perfect balance between risk, which is on that x-axis, and return, which is on the y-axis. So for example, the 100% bonds portfolio, it has, it's right around that 9% risk, and it's getting 5% return. But if we look at that curve there, we can get have the same amount of risk, but get more than double the return with that blue dot. We can get around 13%. So that is what we want to shoot for. Sure, we could go down the line more and get 100% stocks and have more return, but there's going to be a lot more risk associated with it.
Absolutely. So, does this all ring true today? That's the big question. Let's take a look. As you can see, the chart looks much different today based on how these different asset allocations are performing with their return. You can now see that at the same risk level, the return has reduced considerably, and that there is not much more return to be had by increasing the risk considerably. So, obviously, this is the 100% bond. Boy, it's a much smaller corner, right? It's turning, right? So this goes to the 10% stock, 90% bond. Okay. Does the return increase? Well, it does decrease the risk. The return does increase a little, but how much? This one really cracks me up. As you turn the corner, it practically steps right on the 20% stock, 80% bond, almost sits right on top of the 1020. The 1090, and then as you turn that corner now, you're at like 10%. So this is the 30-70. It looks like that's the most efficient one, closest to what the 60-40 was before, right?
Yep.
Wow, big difference. Now all you're doing almost seems, because this is so flat, it's not going up with the return. All you're doing is increasing risk for not much more return as you go out from 40% stock to 60% bond, all the way up. Now here's your 60-40, much more risk. Wow, this is mind-boggling. Unbelievable how it changes. So the portfolio that is the most efficient no longer is the 60-40 bond allocation, is only producing slightly higher returns than the 100% bond portfolio. This outright proves not only that the 60% stock, 40% bond asset allocation ratio is no longer the most efficient portfolio, but it's plainly showing that it is probably more like 30 or 70 bond mix now. And on top of that, what this chart is also showing us is that the traditional static / long only portfolio investment model in general is no longer the best method of investing to maximize returns for a given level of risk, because the additional potential return is so little as the risk or stock allocation keeps increasing, even up to the 100% allocation. I just can't even believe this. What do you got to add for me here, Zach?
Yeah, I mean, it's just, like you said, 1952 is when modern portfolio theory was developed. I mean, there were a couple mutual funds. They weren't really that common. No ETFs. The market now is completely different. I mean, as you'd expect after 70 years. So just important to look outside of what's considered common knowledge and actually, think about it. Is this actually relevant to today's markets? Maybe not. And in this case, it's not.
Zach, what percentage of portfolios do you think out there are built like this?
A lot. And I talk to a lot of advisors, so I have a lot of insight on that.
Would you go out of your limb and say the majority?
Oh, absolutely.
Vast majority.
Absolutely. 95+%.
Yes. I mean, 95 well, all the potential clients I've ever sat down, all of them were positioned like this.
Yeah.
And even what clients that were in 401ks, I mean, 401ks are just this in a nutshell.
Mm-hmm.
You could argue the targeted funds are moving a little bit, but their basis is age. It's not market or economic driven. The asset allocation, right?
Mm-hmm.
Right. So this is exactly why Redwood and other money managers like them have made the commitment to using a tactical investment methodology in lieu of the traditional asset allocation investment method, which was once the status, and I might even say still the status quo for investing across the board, and is still being used most commonly in the industry today. So, with all the evidence pointing towards the fact that investment returns cannot be predicted in any consistent, reliable way, the management team at Redwood has created a philosophy that prioritizes managing the risk of a portfolio over returns. They do this by managing portfolios through the use of algorithms that tactically trigger shifts in the portfolio from higher risk investments like equities to lower risk investments like bonds and cash whenever the market, and vice versa, right? And vice versa, right? Whenever the market data fed into the algorithms dictates. This removes emotions and human error from the equation, and also in most cases allows these shifts to start before the markets reach their lowest lows and their highest highs as well, thus mitigating the volatility of the portfolio substantially in most cases. Anybody that's been on, if you were on last month's webinar where we talked about protected investing, if you were on just our regular general investing webinar last year, we did that one twice over the last year and a half. The number one thing that I've stressed is to control volatility. You need means to do that. What's your thoughts, Zach?
Absolutely. I mean, I think up to this point, if anybody has any questions about the importance of minimizing volatility, it's absolutely necessary, especially with individuals and retirees.
I hope if we drove 1 point home here today, the most important one would be that, right?
Yeah.
Absolutely. Okay, folks, so I think it's very important to point out during this workshop that one of the most important philosophical distinctions between Redwood and most other investment managers out there today is that their whole approach towards investing is built on the foundation of managing the expectations of their clients. They have a 3-step process for this. The first is to set client expectations for their portfolio performance that are not only appropriate, but also are more predictable and controllable. We're going to talk about them in a minute. The second is to implement investments that are designed to achieve those expectations. And finally, is to give their clients curated materials, like the things we're seeing here in this presentation, right? And tools to measure that success, which, by the way, this was basically all the, and it's in the sources. I put the Redwood website on as the source for this presentation, but it actually just came from Zach and all the guys in the think tank there at Redwood. And also the tools to measure that success. And we're going to talk about them too. Do you want to elaborate on this a little too, Zach? Or?
Yeah, absolutely. So, with managed money, which is what this is entailing, it's oftentimes difficult to understand what to expect with the portfolio because, like we covered earlier, who knows what the market's going to do? With things like insurance products, like fixed index annuities, variable annuities, everything is very clear cut of what to expect moving forward, and we can check and make sure everything's acting appropriately. So the whole idea here is just number one is to understand what's going to tell us whether our portfolios are acting under normal circumstances and keeping you, the client, on track with your plan. And then creating an investment implementation to correlate to that, make sure that, it can meet those objectives. And then the third step is just how are we servicing clients? How are we keeping them updated about the portfolio? And also tools to make sure that they are, in fact, acting within their parameters.
Absolutely. Redwood informational materials are second to none. Absolutely the highest quality, best that I've seen. Just wanted to throw that in, a little plug. Okay.
Good to hear.
Bullet point, get the notebooks out. Am I emphasizing that enough? If there's anybody who misses these bullet points. Okay, the first example of the tools that Redwood provides its clients is a max drawdown target range. Write that down. A max drawdown target range. I just said it. It's not written on this slide. It's a max drawdown target range. That's built right into the names of each individual portfolio that the client can use to measure whether their portfolio is on track to meet its goals or not. As you can see in this slide, that each portfolio is named on the right here. Risk tolerance objective, Redwood engineered risk portfolio, budget portfolios, right here. The objective in the portfolios have the name right in there. That DT stands for drawdown target. So, and it says it, the most conservative one, as you can see, starts at the max drawdown ranges of 5% to 8%. So it's looking to stay within that range within a 6-month period of time for their most conservative portfolio. And as you move down, a 25 to 35% max drawdown range for their most aggressive portfolio. Fill us in with these. Let us know what we got. What do you think was the main idea behind doing this?
Well, yeah, this is just understanding drawdown risk, right? So drawdown, if you're not familiar with it already, is just simply the peak to trough loss of a portfolio over any time horizon. It's typically what people care about the most, which is how much
where the portfolio bottoms out the lowest at any given period of time.
Exactly. Yeah, I have $1 million.
That's the max drawdown.
What's that big scary number that I don't want to see my account go down to? Maybe it's $700,000. I don't want to see it go from $1 million to $700,000. Well, that would be 30% drawdown, $300,000 loss. So all this is doing is showing. Exactly. All this is showing is on the left-hand side, this is a long-only portfolio. These are commonly used indices and portfolios in retirees, pre-retirees accounts. So it breaks down from an equity to a fixed income allocation. Over the course of the last 20 years, they've experienced drastic drawdowns in past periods of distress. So you can see how those have done. I mean, look at an 80-20 portfolio. Max drawdown of 45.7%. That would mean your $1 million portfolio almost went down to half, almost saw $500,000.
Yeah, one in like your benchmark type indices or something like that, right?
Exactly, yeah.
Traditional, static, long only, right?
And moving forward, who knows how they're going to do during the next period of market distress, right? Every single time it's a different scenario, something else is affecting it. And so when clients experience losses in those accounts, it can be nerve-wracking because we don't know where the bottom is. And so what we're doing on our side is just defining that up front and saying, look, we have 5 models with different drawdown targets. So 5 to 8%, 8 to 12%. And that is a loss off the peak value of that portfolio. So, I mean, you let me know how much loss are you okay experiencing, because we want to make sure that you are comfortable and you don't experience a large loss that makes you emotional and makes you sell out, because that's only going to further hinder your success.
And what's so genius about it is they're trying to make it so accessible to comprehend for the client? What's the gauge? When I'm talking to my advisor, what can he show me that is a gauge to see if my portfolio is on track? How many people have that with their portfolios? What their clients, their advisor gives them a gauge. So when they get together with them, there's a very objective number that they can look at and say, oh, is it between this range or isn't it? If it is, great, we're on track. We know what the results have been for over the last so many, and we talk about them. We're not going to get too deep into that because it's just so much stuff, but right, we know what the results have been over that. If it stays on track, we look at that. It makes it pretty simple, right? I'm thinking that's what they wanted to have, a simple concept for a tool for people.
Exactly. Yeah. Just easier for clients to understand. It would be a lot easier from an investment management perspective, just to label it 40% stocks, 60% bonds. It's a lot harder to do this, but it's a lot more impactful for the end client.
What does that got to do with the performance? What can people draw from it? Nothing. This is actually a way, in my opinion, of Redwood being accountable being is open to what they're able to achieve and putting themselves out there, their clients, so they have something that gauge them off of. Transparency, what we call it, can we call it?
Yeah.
Okay. All right. So one last thing when it comes to each portfolio, they are created in a way so that each portfolio can be matched to the risk tolerance of each individual client and their situation. So the ERB DT 58, I hope we're going to get to the point of writing that down. That stands for Engineered Risk Budgeted Drawdown Target, 5% to 8%, will be for clients that have a very low risk tolerance. And as you move to the right in this slide, each portfolio can be matched with each client who have higher and higher risk tolerance levels. Any more to add to this, Zach?
Nope. Just, if we look at that middle portfolio, for example, all that's saying is that moving forward from today, the objective is to not lose more than 12 to 17% in a worst case market scenario.
You know, I get a little thing. I always tell my clients, you're not losing money until you take it. You're just seeing a decrease and increase. You're not actually gaining money until you take it either, right?
Yeah.
Right. So you don't lose in the market when it goes up and down, or gain in the market when it goes up and down, when the money's still sitting there. So this is just a target that you want it to try to be at any given time to know it can keep the volatility managed. Am I right about that?
Absolutely.
Okay. All right. So now let's look at the second tool that Redwood gives us to track the progress of each portfolio as well. I'm going to pass this one off to Zach for him to run through it because I think he can do this one even better than me because he's definitely the expert here.
Yeah, so this is just, again, one of the tools that we use to determine whether the portfolios are acting on track. So when you're in for a review, you're going to look at two variables. Let's just isolate that 8 to 12% portfolio you see there on the screen. So number one is we're going to look at the portfolio's drawdown. Is it experiencing a drawdown? If so, are we within or above that 8 to 12% range? Yes, great. Now let's look at the 6-month range of probability. So 6 months ago, I would have shown my client a 6-month range, and there's a 95% probability that starting today at 0, in 6 months from today, you're going to be between negative 3.04% and positive 9.15%. Are we between those numbers? Yes. Well, great. Then everything's acting as it should be. Everything's on track.
And then history takes care of itself. We can only really, when it comes to return, hope that history repeats itself, right? But we've shown that we don't have that crystal ball to know whether it does, but we know that if we stay within these ranges, what it's done in the past, right?
Yeah. we can take a temperature check and see if everything's going well with it.
And you can do something to mitigate the fear you have of anything going outside of these parameters. It's like a way to be proactive, right?
Mm-hmm.
Exactly. Okay. So, all right, folks. Up to this point, we've discussed all the things that Redwood believes don't work and why. And we've talked about their philosophies, their process, and the tools that they offer. But we haven't discussed the exact investment tactics and strategies that they use to deliver portfolios that can mitigate volatility enough for them to have a major positive impact on the overall investment performance. Bullet point again. I don't know which one. You know which one we're up to, right? This might be like, I try to have 6 bullet points for 6 questions. Okay. What they do is they actually combine a traditional strategic / long only portfolio, which we're telling you not to go do all by itself, which they refer to though as the strategic portfolio or part of the portfolio. They combine that with a fully tactical portfolio in order to come up with what they call an engineered risk budgeted portfolio, like I said, or ERB, as you've already seen. It sounds pretty simple, but each portfolio is also layered with 6 different fixed income allocations and 7 different equity allocations. That kind of gets economic and all that type of stuff, right, Zach? Each of them they specialize as well. And we're not really going to dig too deep into that because that would really take us down a rabbit hole. But I can assure you that they are very sophisticated and certainly worthy of a master's degree in finance. Believe me, I have sat through every single monthly portfolio update meeting, and it's hard to stay up with the level of thought and sophistication that has been put into these portfolios. Sometimes I'm sitting through that and I'm like, man, they're talking about one of the fixed income allocations and, what they did with each of those allocations in the fixed income and what they did with them in the stock one for each month when they were basically triggering the data for the algorithms in that and the things that they did behind the scenes to really stay with the underlying theme. And I'm not going to lie to you, Zach. I'm like, okay, guys, thanks. I really appreciate it. No, it's crazy. I love this. At the end, I know I'm not alone because at the end, you got like 500 advisors on it, right? And they say, anybody got any questions? There's like 3 questions, right? It's like, okay. And then I'm just sitting back, I'm hitting questions like, okay, so did we go in more risk or we risk off a little more? Like, that's all I want to know. Like, are we more risk? Are we, because that's what I tell my clients. They're moving these algorithms. My clients get emails whenever there's triggering the trades. So they know when there's movement, right? I just got to have the discussion. I think we pretty much all know when the market's moving certain ways in the economy, like when the war hit and the Fed does their thing and there's, heavy trading going on. But I think pretty much everybody knows the direction we're going, right? But anyway, so that's exactly why they've delivered the results though that they have since 2011. And I don't know, Zach, you're the expert. Give me your thoughts on give us a little breakdown on this here.
Yeah, so the real highlight here is just we're not being binary. We're not choosing only tactical or only strategic because there's pros and cons to both strategies. And so just to kind of summarize too, strategic is buy and hold, where the portfolio is always invested. You can't get out of the market when it falls. And tactical on the other side of things has the ability to move out of whatever asset class it's covering into a safe haven like cash and actually get out of the market. I want out. Let's let everything settle down.
It's the one getting fed by the algorithms and all that kind of.
Yeah, that has all its own independent quantitative strategies that drive them and everything. But each strategy has its pros and cons. And so I think the next slide is going to cover really what breaks all of that down.
All right, yeah, let's jump into it.
So yeah, the left side is showing what a strategic long only portfolio is. So the pro here is that when the market goes up, you participate in it.
This is a peak and a trough, right?
Exactly, yeah. But the con is that when the market falls, you have no way out. You're going to have to go down with it. And the only thing that goes up in a down market is correlation. So stocks fall and bonds fall.
I
so
know.
It fails when you need it the most.
Especially lately.
And then on the sorry, my camera's all wild. We have a sunset happening right now. But on the other side, in the middle is a tactical only portfolio. So the pro here is that you have the mechanisms built in to get out of the market and avoid some of that loss. But no one's going to be a perfect market timer and sell out at the top, buy at the bottom. And so you might not be invested right away to participate in some of those gains. So we do the third column where we combine both. That way we can pull on the strengths of both styles and get the best of both worlds.
Yeah, I mean, that's the secret sauce, right? I mean, when it's all tactical, they might go too much to safety and they can't get back to risk on quick enough because no one can time the market. And they might miss out on returns.
Absolutely.
We lost your photo. We lost your video there, Zach.
Yeah, I'm just closing the blinds real quick. I don't want to distract people with my my shadow.
Oh yeah, no problem. Yeah. So now the combination, this image on the right is the mix between the two. So in this situation, you see these points that are that have the lines drawn to them. Seeing the all strategic long only, you're either seeing all the highs and then all the lows, or you're seeing just kind of in between. You're not getting enough of the highs, you're not getting enough of the lows. In this, you're seeing you're getting highs, you're seeing some lows, but you're also picking up sooner because you're not all tactical. You're invested as well. So I got that right?
Yep.
All right, we're rocking and rolling. Okay, now that we have a better understanding of how the Redwood investment strategies work, let's take a look at how it has played out in real life and what kind of results these things have delivered. Okay, so in this real life example, it's showing how an ERB, what's that stand for? Engineered risk budgeted 25% to 35% portfolio performed next to this 80% equity, 20% bond traditional portfolio. Gonna let Zach lay out the rest of it.
Yeah, so this is a real life example. This was during COVID 2020. That was a pretty interesting market because we saw such a sharp decline and then such a sharp V-shaped recovery.
Never so scared in my life.
Yeah, it was pretty. People forget that there is even a market downturn during that period because
my clients weren't in Redwood at that time, so they had all we had moved them after that. But they were a lot of them were tactical, but they weren't. That happened so fast, you couldn't de-risk fast enough.
Yeah, exactly. So let's look at the two examples, right? So the first one is the 25 to 35% drawdown target portfolio. And the second is its benchmark, the 80-20. So you can see on the way down, we were able to minimize losses by 6% less than what the benchmark did. Doesn't seem like a big number, right? Only 6%. And then on the upside, we captured less than half of what the upside was. So what do you think, which portfolio out of the two do you think ended up higher than the other?
Well, you're looking at, see, this is something, this is what my clients got to see, right? Because, well, you're thinking, man, you're down 21.6. You're not realizing that an 80-20, which is the most aggressive portfolio usually that you see that has any kind of bond mix in it, right? It's down 27. They're not seeing that, right? They don't notice it as much because they're not in it anymore, right? They need to know what's going on behind the scenes. Now, when it took the rebound, oh man, this one got 11, almost 12%. They're only up almost 4.5 or 4.5. Well, I'm not doing as good as them. That's what it looks like, right?
Let's find out.
Let's find out. Drum roll, please. Ta-da! Ah, what do we got here? So let's take a look at this. What's it say to? Well, read us. Get us down.
So I mean, look, the ERB ended up higher. We actually had our analysts run these numbers multiple times because the math doesn't seem like it adds up there, but in fact it does. I assure you, after running it through 5 times, it does line up. So
it's
exactly
crazy. It's exactly what I showed everybody when I showed them the average return versus the compounded return. The numbers have to bear it out, not the percentages.
Exactly. And this just shows, you know, the idea of winning by not losing. That's the whole focus, is just win by not losing. We call that exposure management, exposing yourself to risky assets during good times and not exposing yourself to risky assets during bad times.
Absolutely, man. That was a great finale on this, because this is the proof in the pudding. Okay. So now, folks, I hope you'll have a better idea of what Redwood and tactical investing is all about now, and what they can do for your portfolio. That was unbelievable stuff, Zach. I'm so happy we were able to get this together, man, because this is what I want people to see. Absolutely wanted to see, and I wanted us to be able to present together. So, all right, so that concludes the educational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone that is attending it. I want to offer everyone here with us a no obligation complimentary investment plan analysis. And I want to take a minute actually to explain a little about what that entails and what you can get out of it. So this is what it entails. First, there's 2 ways we can actually meet to do this. The first is online using Zoom, which is almost just like how we're doing this webinar, but instead we'll both be able to see and hear each other, and it will be completely private. Or we can meet in person at our office in Fort Washington, PA. It's just off the PA Turnpike. Actually, if you can see in the back, that's the Turnpike right there. Okay, so you can see it in the back. Second, it is a 2-step process. First, we'd meet to gather all the information that I will need to do the analysis. And second, we meet a second time to go over the results of it. Finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to integrate one of the low volatility tactical investing strategies that we discussed today, or perhaps even some other recommended adjustments if they can benefit you with your current financial plan. So if you would like to take us up on this no obligation complimentary investment plan analysis, Rachel, not I, will be posting it in the comment box, a link to a 60-minute meeting for you to do. Are you doing that now, Rach? All you have to do is click on that link during our 6-question quiz or our Q&A session, and you'll be able to schedule a time at your convenience directly on my calendar today. Also, we're going to leave this up for a while, so that about 30 minutes after the webinar, we're going to leave this webinar up live. We're just going to turn off our audio and video so you can go back into the comment boxes and copy and paste anything. We're going to have the resource, which is really just the Redwood's website this time around. Usually it's a lot of resources, right? And we're going to have these links for a 60-minute meeting and for even a 15-minute Q&A phone call. If you have questions about anything that you want to ask before you book a 60-minute meeting, we'll be putting that up. Rachel's going to put that 15-minute Q&A phone call link meeting up as well. Also, we'll be leaving this, I said it, I'm going to reiterate, leaving it up about a half hour, we're going to say, so you can copy and paste everything. You'll have plenty of time. Okay, that's it, folks. Now let's jump into our 6-question quiz and our Q&A session and get going here. It's where the fun begins. Wonder if Bob's on. Is Bob on? Let's see. I just got to take a peek. Bob's on twice. Some other past winners are on here. Okay, so let's play it out. First question. Remember those bullet points. What does Redwood call the approach they take in regard to their portfolios? I mentioned it in the beginning. It's the approach. It's 2 words. First, Bob, and Ann Fee. All right, we're going to give this to Bob. Very close second there, and it's hard to tell. We don't have it in seconds, but he was first on. Okay. Number 2. What finance theory did Nobel laureate Harry Markowitz give us in 1952? Bob's kicking it out again. He's a speed typer. See if anybody gets it. Anybody else? Patsy? You were a minute behind Bob, Patsy. All right, we got to give that to Bob too. Okay, yo, Bob, let's see if you can give everybody a 5-second delay. Now you have a handicap in here. A 5-second delay. 3. What is the first example that was given of the tools that Redwood provides its clients that is built right into the names of each individual portfolio? Remember, I said it wasn't actually written on the actual slide, but I said it really, really, really loud. And it's 3 or 4 words.
All right, let's see.
Bob's going to give everybody.
No,
Patsy. Ann. Going to give that to Patsy. Ann, you're hot to trot, though. You got it going. All right. 4th question. What does Redwood call each portfolio before it gives the max drawdown range in the name? So the portfolio's name starts with this and then goes to the max drawdown range. What do they call that?
These are hard ones this week, right?
Yeah, but I did major bullet points, and there's an acronym. I'm going to tell you the acronym. Do we need to? No. The acronym was ERB. Good one, and you got it. Patsy got it too. Nice. We're having a nice fair. I appreciate that, Bob. Good job. Okay. Final one. Name one of the 2 types of portfolio methods that are combined in each Redwood portfolio. One of the 2. We showed you how they mixed, right? And now if you were just in the one type, you would see all the highs and all the lows.
Ann got it.
Good job, Ann. Okay. Name the other portfolio method that is combined with each Redwood portfolio. Final question. And it's part of the name of this webinar. Bob, good job. You did it. Oh, you've got that. Great job. All right. I think that was pretty good. Bob gave us a running chance with some of the other folks, and that was pretty cool, Bob. Now, do me a favor, Bob, Patsy, Ann, put the name of the store you'd like your $10 gift card. Bob's going to have a $30 gift card. Ann's going to have a 20, and our Patsy's going to have one. Is that what it is? Yeah, I think one for Patsy. Put the name. Bob's going with his usual pick. Oh, good one, Ann. Nice. All right, Patsy, got to put it in there. Okay. So now we're going to go over to some questions. I do have to say that we did have a few questions. So I think there was 4 questions come in by email. So people did take us up in that. And I think Rachel has them, right? And but let's see if we have any in the Q&A. Okay, so let's go with the email ones for now, Rachel.
So let's see, we got how much less could I expect my portfolio to draw down than it would have in a traditional portfolio?
These are all for you, Zach.
So, I mean, that's going to vary a little bit depending on which of the 5 portfolios we're looking at. It's never going to be like a specific number where it's going to be, say, 10% greater than what the long only equivalent is. The last chart I saw in terms of, for example, the 25 to 35%, I think we're looking at a delta of about 10%.
Okay, that's fair enough. So you could probably, give that as an estimate of some sort to give for that portfolio.
Yep, correct.
Okay. All right, yeah, Rachel.
Do tactical based portfolios usually get a higher return than traditional asset allocation portfolios?
Traditionally, it varies, right? It depends on what time frame you're looking at. We've seen a lot of success with ours getting higher returns than that. But with anything in terms of performance, it all depends on what kind of time frame we're looking at, right? If we're looking at it during COVID or even this year's market, tactical is obviously designed to help minimize loss. And so most likely you're going to see that portfolio outperforming something that's not tactical. But, just going back to what we originally set out in our disclosures is that moving forward, we have no idea, right? Performance is something that we can't control.
Is it fair to say that, at least when you bear out the numbers, and I thought about getting into that one. I have a great slide. It just shows you an example of average returns versus compound returns. The two portfolios that get the same exact average, but they get them one's in a more volatile way and the other's in a less volatile way. When you bear out the numbers in my example, the less volatile portfolio that averaged, the same average, numerical average, ended up getting almost a 2% additional compounded return on the actual money. So that was a nice, neat version of it. It wasn't real life where it's, the ups and downs. So I guess, is it fair to say theoretically, if it bears out like that the possibility is there? Is it fair to say that?
Yeah, absolutely. 100%.
So the math dictates it. You can't speak for real life, right? But you can speak for the math as it relates to it when it's a mano, so to say, in terms of numeric average return.
So a lot of the partners at Redwood, they have backgrounds working with hedge funds and certain thing and similar type strategies. And so what they found is a lot of times true alpha. So alpha is a word used to describe additional performance above a given benchmark. That actually is most often driven by exposure management, where during periods of loss, we want to de-risk, get the exposure away from whatever the allocations are towards. And then when we start to see uptrends, we start putting allocations back towards that. And that's really the root of this whole process is trend following. All of our strategies are rooted based on different quantitative measures of ways proven to participate in those trend management. And so trends going down, de-risk, trends going back up, you get back in the market. And so theoretically, in that sense, absolutely great, a lot of opportunity for alpha in that sense.
I mean, I'll tell you, I've seen some of these algorithms, and I think most advanced college calculus professors would be proud of them. Would you agree with that?
Yes, absolutely.
That's why we don't show them in this kind of stuff, because none of us can explain them, right? But we know what they're doing and where they're feeding their data from, and that's where you start to understand that this, kind of like controlled way of doing it is so much more reliable than just human instinct or emotion. Because you can't be any more calculated than that, right? There's no hunch involved. So anyway, so that was great stuff, Zach. I appreciate it. Folks, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about important topics like this. Believe me, I truly commend you on that. I also want to thank our extremely very special co-host for today's webinar, Zach Willms from Redwood Investment Management. It's been an absolute pleasure having you educate us on this tactical investing and how Redwood goes about it, because it's such an innovative and little understood method of investing that certainly could become a big part of so many people's financial portfolio success if they knew more about it and if they knew more about Redwood. Thanks so much for doing this for us today, Zach. Greatly appreciate it, buddy.
No problem. The pleasure is all mine. It was great. It was great doing it. Thank you.
Hopefully we can do it again, maybe mid-year, 6 months down the line, or at least annually.
Yeah.
Also, on behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, say goodbye, Rachel.
Night, everybody.
And myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area. I want to remind you that if there's anything we've discussed tonight, or anything else for that matter, that you would like to discuss further with us, you can reach us at either 215-804-9708 or by phone, or at info@plcfs.com. Or to make it even easier, just go to our website at PLCFS. That stands for plcfinancialsolutions.com. You can even put that in there if you want to write it all. And all our information is always there. Also, please mark Tuesday, September 27th, 2022 at 7 p.m. on your calendar for our next webinar. It will be called An Intro to Medicare. We're going to be getting into Medicare season coming up October 15th. Rachel knows all about that. Believe me, she's doing it every day. Remember, we do them on the last Tuesday of every month. Have a great Labor Day next week, and we'll see you guys next month. Good night, folks.
Hey, everybody.